Thank you for joining us for our My Wealth webinar with Javed Mirza. Javed is a chartered financial analyst and chartered market technician, and he's the head of our technical analyst department at Canaccord Genuity. It's always exciting to talk to him and get his update. He's always got his hands on the pulse. So it should be a good time given all that's been going on in the markets. We also have Dave Townsend, Senior Investment Advisor, as well as Rahim Samani, Senior Investment Advisor for the Townsend, Samani and Hunter Group. With that, I'll pass it over to Javed. Javed, thanks again for coming on, and excited to hear what you say.
No problem. Thanks so much for having me, everyone. So this is just our quarterly update, and it's pretty timely because we've been talking about this intermediate term correction over the last couple of weeks that we're looking for. Basically a 1 to 3 month correction that could be down anywhere peak to trough, call it 5, 7, 8, maybe even a little bit more. But the bottom line is, as you guys are aware from talking to us over the last year or so, we believe a new 4-year cycle has taken hold. So the good news is, hopefully in our last chat, we've kind of positioned you to take advantage of this new cycle, and hopefully that's worked out so far. But either way, the good news is our work is picking up that we're in a new 4-year cycle that began October 13th, 2022, and that has upside out into, call it, 2025. So we should have at least another, call it, 2 years of upside before we start to see some choppiness taking hold. So I'm going to talk about a variety of things. I'm going to try and keep this tight. Jeff, how long do you want me to go for? Like 20, 30 minutes?
Let's keep it at 20, and if there's questions, and then also
Perfect.
Just some of the things before we get started. With your work, can you give us a little bit of background in terms of what you're seeing, what you're looking at, how you're making your predictions and forecasts? Yeah.
Perfect. Yeah, so we'll keep it tight because I think everyone knows or who's been on the call has seen our work before. So the biggest technical development that has occurred here is that we've got this sell of a generation in US 10-year bonds. Basically, rates are going higher for the long term. So the last time we saw this was from the 40s to the late 70s. So you can still get these uptrends in there, but there is the potential, we believe, for some problems that higher rates are going to cause, and we'll talk about that a bit later. Our view, though, is that into the end of the year, real estate and financials are likely to be very compelling opportunities, presenting a very attractive reward risk ratio. So love the Canadian banks, love real estate, basically financials in general in Canada and the US. And then just highlighting our calls so far, here's where we've been as of June 30th. So last year, if you guys recall, our view is that the market was going to correct. And that was a very contrarian call, and that has worked out well so far. So this year so far, pretty happy with our calls. We're underperforming a bit just because on a couple of these calls, you can see right here and right here, and that's because Infotech has been such a strong force in the first half of the year. But we strongly believe that these areas of the market here, so industrials and base metals, are going to outperform into the end of the year. So we're not too concerned about this performance. So just, we're comparing, apart from the commodity, comparing right here, this is versus the CRB, but the rest of this is versus the CRB, the S&P 500. So here's our return, and then here's the S&P 500 return. But as we mentioned, we think we'll see a catch up in these first two ideas here at the start of the year. Okay, so in terms of what we're seeing, I'll just talk high level here. We'll just kind of glide through this. So, what I'd say is everything that you see in the stock market has happened before. And if you step back and look long term, look at these longer term trends, the stock market remains one of the best ways to, basically create wealth. And the stock market goes through two main phases. This is the secular bull market. These are these blue arrows. We believe we're in that, and we have upside out until at least 2030. So it's 2023 right now, and we believe that every 3 to 5 years, which I'll show you. I was kind of trying to highlight that on my arm, but here, every 3 to 5 years, the market makes a major low. Now, that's not sorcery or astrology. What that is the business cycle. So every 3 to 5 years, the market goes through this cycle. And so what we were telling clients, and I think some of you, I don't recall exactly how many calls I've done with Jeff and the team, but basically last year we were telling clients at the start of the year, hey, look, we're here. We think a correction is coming, or the contraction phase of the business cycle. So we've gone through that. Late in October of last year, we were telling clients, look, we think a new cycle is starting. And right now, we think we're right on the cusp of this shift into phase 2. And we think this pending correction that we were talking about, that could last 1 to 3 months and see us down, call it 5 to 8%, is going to mark this transition. So at the start of the year, technology and cyclicals, so consumer discretionary, have been leading, but we think this transition here is going to see industrials, basic materials, and financials lead and take the market higher into the end of the year. But the key takeaway here is this phase 2 should last from mid-2023 all the way to mid-2025. This is the boring middle. And if we go back a couple of slides, we believe this right here, October 13th, was a major low. Here's other major market lows. This was in 2016, this is in 2018. But what you can see here is that basically we are through the contraction phase, and now we are starting the expansion phase of the next cycle. So the economy is always lagging a bit, and that's why you're seeing a lot of strategists and a lot of talking heads talking about the bad economic data. But the key takeaway that you always have to remember is the stock market is a discounting mechanism. So even though the economy bottoms here, the market bottoms here. It's always looking out ahead. So that's the good news, is that as Jeff mentioned, we look at the pulse of the market. So we've been pretty happy with our call here over the last couple of years, because it's been pretty good, both in terms of warning clients of the corrective phase and letting them know that a new basically bull leg is underway. So coming back to this longer term chart, and in terms of technicals, some people focus on technicals for shorter term day trading, but you'll notice a lot of these charts in here. These are 100-year charts, taking advantage of these very, very long-term trends. So what you can see here is these red shaded boxes are secular bear markets, effectively a 10-year sideways trading range. The last one we had here was from 2000 to 2010, and then from here through the late 60s through to the 80s. And what that is that period is essentially a consolidation phase. You're adopting new products and technologies. And then once that adoption phase is over, that's when you've really got this strong runway. And so I know, I'm sure you guys have heard what's going on with AI. So the big boon for AI is that it's going to increase productivity across the board. So it's just going to give people more time to do more things. And that, of course, means more things get done. And if more things get done, then that should be good for companies selling goods and services, because more goods and services are going to be purchased in an economy that is more productive. So in terms of other things that we want to talk about, just highlighting probably, this is just a chart of the TSX versus the S&P 500. I'll just hit some of the highlights here just so we can keep this meeting tight. But this ratio here of the TSX to the S&P 500, you can see during the secular bull market from 1980 to 2000, TSX underperformed, but from 2000 to 2010, the TSX strongly outperformed. And one of the things I want to highlight, going back to this slide with the secular bull and bear markets, actually I'll use the same slide, same concept, different slide, is these red boxes highlight previous secular bear markets and equities. But what the important takeaway is 2000 to 2010, and then here during the late 60s through to late 70s, we had secular bear markets in equities, but those coincided with secular bull markets in commodities. So our view is this bull market should have legs out into 2030, and then I think we're going to see something similar here, and that should be good for Canada. So we should see Canada outperform. We should see another commodity bull market. And that's what really this slide is telling us, is that here we expect the TSX to continue to underperform, but if this continues and we get out to 2030, that's when I think we could see commodity, the next big commodity super cycle, similar to what we saw here from 2000 to 2010. So key takeaway in all of this is just in terms of psychology, human behavior, those are the things that don't change. So we've seen so many changes throughout the course of the last 100 years. Everything has gotten better. We now have like supercomputers in our hands, which you can use to call a cab and take you wherever. We've got amazing advances in biotechnology and healthcare. All of these are very positive and reaffirm that the underlying wealth creation aspect and of the stock market, but also basically human progress. And that's what I really want to highlight in this chart here as well. Let me just clean it up so you guys can really see, but I think it's something to really reflect on. You have all this gloom and doom, but the bottom line or the key takeaway is what a great tool for wealth creation this is. But this is also showing us human improvement. So this is the period after World War II. And then here, this is during the 80s and all the different revolutions and new concepts. So like transistors, calculators, television, and now we can stream mobile, like movies on our phones. So it's just human progress, and that's ultimately, you know, the thing to focus on. So we get these corrective phases, and that's what we believe we just shifted through. So let me just show you one last slide here, just reaffirming this. So in terms of every 3 to 5 years, you see the market go through this major corrective phase. So this was 2000, this was bursting the tech bubble, this was the financial crisis. But the reason this was so brutal is because this was during a secular bear market. So this was essentially a sideways choppy trend. You know, this was Amazon, Facebook, they were trying to figure things out. And then once they did figure things out, that's when we got this really big up leg. And you can see these 4-year cycle resets, which is the contraction phase of the business cycle, they did occur. Here was the Euro crisis, here was the renminbi revaluation, here was the US-China trade war, and then here, this was the gilt pension crisis in the UK. But the market survived, and it's kicking, and now it's poised to, here you can see, to push higher and break out to new highs. So just want to highlight our process. Another part of our process here is just, we look at, just moving ahead here, we look at, you know, stocks, the percentage of stocks with bullish patterns. This is telling us back in, you know, Q3 2022, they got bombed out. This was US-China trade war. Here's the Euro crisis. Sorry, this was the renminbi revaluation. Here was the US-China trade war. So all of these things are telling us the same thing, that we've got to a level where historically provided major support. And then same thing here. Investor sentiment in Q3, basically for most of last year, was quite bearish. And you had to go back all the way to 1990 during that stealth bear market right here to see investor sentiment so low. So, you know, we've survived, we've made it through to the other side, and we see very positive 2 years out into 2025 before we revisit that bigger cycle in terms of, you know, going from expansion back to contraction. So in the next 4 minutes, I'll quickly cover rates, which I think are important. So this was a massive change here. Rates moved above the 50 level on RSI. Longer term price momentum is trending higher. This is the US 10-year yield. And this is a very long-term chart. I think this is going back to the 50s. But the key takeaway is we broke this 40+ year trend line. So what we think is going to happen is over the next 2 years, we think this hiking cycle will ease and we'll be in a sideways trading range. However, let's fast forward 2 years. It's call it late 2025. The economy is going to be firing on all cylinders, and the Fed's going to have to hike again. So we don't think we're going to revisit these lower rates that we've seen here over the course of the last, you know, call it 15, 20 years. And you can see here, this is 2000, 354 all the way down to essentially zero. But what we do think is going to happen is and this is off the charts, but from the 40s to the 80s, you had this same thing, period of rising rates. So we think rates are going to stair step higher, but ultimately call it after the next two cycles, maybe rates are around 8 to 10%. And that we believe is going to cause the next secular bear market in equities, because, why put a lot of money at risk in the market if you can just earn 8 to 10% on your checking account. So we think that is coming, and call it the next, 6, 8, 10 years. So that is something on the horizon. For right now, a new 4-year cycle is underway, and everything is positive because we think rates are going to be basically moving sideways for the next couple of years. So just want to highlight a couple of charts here, just reaffirming how bullish things are globally. This is the DAX in Germany breaking out to new highs, and then this is the CAC here in France breaking out above the 2000 highs. This is very, very positive. This is telling us there's a bull market globally. Japan just reached levels that it had last seen back in 1990. So this is quite positive. So we're seeing it in France. We're seeing it in Asia. And then one of the other things I want to highlight here is India continuing to push higher. So another Asian stock market making new highs, which is very positive. So globally, things are basically doing really, really well. And then just in terms of our ideas for this year, into the second half of the year, we highlight real estate and financials. Love the Canadian banks here. Industrials, this is defense in the US. This is basically based on that Russia-Ukraine conflict, so that should continue to see some inflows. And then copper miners and steel miners, this looks very positive. Looks like they want to break out and push higher. Home builders have had a very, very strong move. We highlighted them at the start of the year. And we do believe real estate is going to see a catch up. But one of the other things I want to highlight here is Argentina and Mexico. And Argentina has broke out strongly. We highlighted this at the start of the year. I think it's up almost 20%. And then Mexico has broken out above the highs it's set back in 2013. All of this is very, very positive and bodes well for the market in the future. And then just finally, last but not least, we highlighted gold and platinum. Gold's held in pretty well, but platinum's been a bit of a laggard. But similar to everything else, we do think that we're on the cusp of starting a new cycle here. So that should be a tailwind into the end of the year. So team, I'll turn it back over to you for any questions.
Just for participants, there is a Q&A button. If you want to type in there any questions you might have or anything you want Javed to look at, let us know. First thing is US dollar. What are you seeing that in comparison to the Canadian dollar? What are you seeing that in comparison to global currencies?
Yeah, so we believe we're in this new long-term uptrend along with rates rising, which makes sense if if the US is going to continue to be in this higher rate regimen. But over the course of the next 2 years, we think it's going to be in a kind of a choppy sideways trading range. So you can see 108 to the upside. We've got this 97.50 to the downside. I'll flip ahead another couple of pages, just highlighting US dollar here. So we think it's essentially going to be range bound, which is good for commodities because it should leave them. It should basically kind of remove that headwind. So call it 97.50. I have our weekly note as up as well, and I can just kind of go in there and highlight it. Just here. So 90, call it 108 maybe to the upside, 96 to the downside, but we do think it's going to be in this kind of choppy sideways trading range for the next 2 years. Does that help?
Absolutely. And then a little bit further, one of the questions from the audience is the XLRE. Do you have a price target or a price range that you're kind of seeing it into?
Yeah. Let me just go back to that. So here's XLRE on the left-hand side. So it's continuing to improve. We'll take it as it comes, but what we think is going to happen is at least this 42 level is what we're looking to reclaim. So I think we're around this 38 level right now. So least another 10 to 15%. Of course, this is not going to include dividends. And this is a function of time as well, because you're kind of running a little bit against the clock, because once we come into that corrective phase, we think rates are going to be hiked higher. So we think you have runway to 42.31 and then maybe even all the way to 45.67. I don't know if we're going to reclaim these recent highs, just because, remember, these highs here were put in with really low interest rates. And so with higher rates, I think it's going to be tough for real estate to come back to those levels we saw. But I think this 42.31 level at the very least, and then potentially this 45.67. So somewhere in here is where we think it'll be in the next 2 years, excluding the.
A little bit further on, typically when you're seeing these phases, how long are you seeing us sit in phase two? I know there's a lot of people in the audience from Alberta
Yep.
affected by energy prices, and energy is a phase three. When do you start seeing them play out? What are your kind of forecasts for moving from phase two to phase three?
Yeah, great question. So let me just come back in here. So we think energy is going to essentially be range bound. So what I would, for the next 2 years, so as we come into, call it 2025, so maybe late 2025, we think energy is going to perk up. Maybe it does it like early 2025. And then through the market top, you can see energy performs well here. So call it 2025, 2026 is when energy should start to pick up again. And that, reinforces our view. Let me talk about crude. We think you're going to see the same thing. So we think you're going to see crude essentially in this sideways trading range, call it 85 to the upside, 60 to the downside over the course of the next 2 years. And I don't know if I've talked to you and the team about this, but here's the pandemic right here. But notice here was the start of the new cycle. And notice for a year and a half or year, it basically moved sideways. We think if the pandemic didn't occur and you didn't have this big washout here, we think energy would have done the same thing, basically move sideways crude, move sideways for a year and a half, 2 years, and then start to pick up late cycle. So we think, call it late 2025, you'll start to see crude run again, and it could easily take out this 120 level here.
Just on the business sectors, you have 3 sectors within the business cycle that outperform. Is that relative outperformance or absolute outperformance? How do you view those sectors, and what are you
that should be
gauging?
Yeah, so what this is telling us, the key takeaway from a high level is now's not the time to be defensive. Now is the time to be more offensive for the next couple of years. And then once you start seeing energy start to pick up, that's when you want to start, putting on the brakes and starting to get a bit more defensive. So, at the margin, rotate out of some of your more defensive areas, defensive plays, and into the more cyclical plays. So, we've talked about this too, depending how fancy you want to get. We think there's a market correction coming. We think it could be, starting to take hold today. And so you're going to see the defensive sectors, healthcare, utilities, staples, they're going to catch a bid during this weak phase. But once that weak phase is over, we'd be looking to trim those names and move back into the more cyclical areas of the
market. Right. So you've been very contrarian to the typical narrative. People have been extremely bearish this year, fundamentalists, quantitatives alike. What would change your view of where we sit and make you reevaluate your positioning?
Great question. I've been trying to think about that. The thing that would concern me the most is if we have some sort of big shock that causes energy prices to spike. That would put the economy in a really bad situation, because then the Fed, I don't know how they would react in terms of being forced to hike. You've seen inflation come off, but if for whatever reason, we see this massive, I'm not sure what the catalyst would be, but I think energy spiking here would be really bad across the board.
Okay. Perfect. Dave, Raheem, anything that you want to cover?
Hey, quickly, Javed, just one question or a couple of questions here. Financials continue to be underperformers, but you're highlighting that there's a tailwind that will start to cause them to emerge. You saw that in U.S. financials this week. That's the first question. What are some of your favorite names on Canada and the U.S. side? And question number two, I won't get into the interest rate sort of discussion. I think people are pretty frustrated with the Bank of Canada per se in terms of guidance. But any thoughts on rates and a leading question into the U.S. election and the election cycle? So three-pronged.
So in terms of stocks, I won't talk, just in terms of compliance, I'll try to shy away from some ideas. What you can do is you can send along our TSX Turning Point and Big Board. I think you guys are pretty aware of how to use that tool. But if you have questions, feel free to reach out to me on that. What I would say is banks, life cos, I think would be another great play, because I think higher rates are going to be a big tailwind for them, for the pensions and the annuities. So I think life cos are in a pretty sweet spot here. They pay a pretty good dividend, both in Canada and the US. So I'd be looking at financials and life cos, banks and life cos, I think would be the big plays. I don't think you can go wrong with the Canadian banks. I know they've been in this sideways range. And what I want to highlight here is, this is just from our weekly note, and this is what we've been quite bullish on financials. And what I want to highlight here is this chart just highlights the relative performance of the XLF versus the S&P 500. It's the financial spider or ETF. July to September, the bottom number here is the percentage return, and the top number here is the percent it closes the month higher than it opens. Essentially, Q3 financials are flat, but in Q4 you see a pretty big pickup. So I would be looking to buy financials here over the course of the next, we're getting close to the end of July, so we're basically in August. I'd be buying them here, especially if we get a correction. You can see regional banks in the US are doing well as well. And that's our call. That's our view, that I think you'll be pretty happy if you buy them here and are sitting on them at the end of the year.
Javed, it's Dave. Thanks. First of all, thanks for your time. Secondly, everybody's bullish on copper. I'd just like you to sort of run through your thesis on copper and where we are.
Oh, yeah. So we did this joint note with our fundamental analyst this morning, Dalton Barreto. And a couple of things. So first of all, if we're going to shift into the boring middle or phase two, basic material should do really well, because that means the economy's picking up. You're using copper in electric vehicles, housing. I'm sure you guys have heard copper is the metal with the PhD in economics, because it has so many economic uses. So really like copper. What I'd highlight here, here is we highlighted copper stocks at the start of the year. Let me just go to that. Right here. So we're seeing long-term price momentum improve. Sorry, I think. Okay, long-term price momentum improving. RSI above 50, and this is just positive here. So what I want to highlight here is, here's the big. This was the 2018 cycle, so this is contraction, and then you saw it start to come off. But what we're seeing here is you've got expansion, contraction, and now we're back in the expansion phase. So I do expect copper, especially. Let me talk about copper by itself here. This is from our most recent weekly note. Hope you guys can see this okay. So here is kind of this pause through phase one, and then the run up through phase two, and then here's the contraction phase. But what you can see here is we're improving, and most notably, you've got this series of higher lows and then higher highs as well. So especially if we take out this 410 level again, that's really going to tell us that, hey, look, something is improving and changing, and that sets up a test for the 475 level. So really like copper and copper stocks. We highlighted a couple of names in that report. I think you guys are, obviously feel free to send that on. And we've highlighted, some of the charts in there for the copper stocks look pretty good. I think the ones I can talk about because I've highlighted previously, we've highlighted here. So Capstone and Ivanhoe are definitely two of the names we'd be looking at. Oh, I saw the question on Canada or US for banks, both. And just, so we've highlighted these ideas here over the last, starting in, I guess, April, and then most recently back in June. BMO, National Royal. We were on BNN yesterday as well, highlighting National. It's the best looking chart in the bank space.
Well, I think, Dave, anything further?
No, I just want to say thank you very much, Javed. As always, I appreciate your time.
Awesome. Thanks so much for having us. Hopefully this was helpful. And if there's anything I can do to assist you or the team, please don't hesitate to reach out.
Perfect. Javed, I really appreciate it. And everyone on the call, thank you for sharing your lunch hour. And we'll chat soon. Give Dave, Raheem, or myself a call or an email if you'd like to discuss anything further. Have a great day. Bye for now.
Thanks so much, guys.